will discuss on the capital gain. It's an interesting question. Needs a lot of discussion in this problem. Let's have a look into this question first. Ms. Vasumathi purchased 1000 equity shares of Rajesh Company Private Limited on 28 to 2017, that means 17-18 financial year, for ₹1,20,000. The company was wound up on 31/7/2023. The following is a summarized financial position of the company which is given in the problem. 6,000 equity shares, 6 lakhs, general reserve 40 lakh, provision for taxation 2,50,000. Agricultural lands 42 lakhs, cash at bank 6,60,000, 50,000. The remaining assets were distributed to other shareholders in the proportion of their shareholding. Market value of the 6 acres of agricultural land is 10 lakh per acre, market value. The agricultural land received above was sold by Vasumathi on 28 to 2024 for ₹15 lakhs. I discuss the tax implication. It's a data crunching problem. First, Vasumathi is holding 1000 shares in a company having 6,000 equity shares. Therefore, she is 1/6 holder. What is happening here is that this company has got 2 assets. One is the agricultural land, another one is the cash at bank. This is getting distributed to the shareholders. Distribution of assets on liquidation by the company to the shareholders. That's what is this question. Let's look into the taxability discussion here. First discussion. At the time of distribution, whether any tax liability is there in the hands of the company, answer is no, because the company is distributing its wealth, or whatever is the remaining assets, to its shareholders, which is not at all taxable in the hands of the company. However, the TDS provisions shall be applicable. The question doesn't talk about the company. The question asks about Vasumathi's hand, how it will be taxable. There are 2 discussions here. One is Vasumathi or all the shareholders got 2 assets. One is land, another one is cash. Land also she got 1/6, cash also she get 1/6. Both the land and cash 1/6 will be taxable minus the cost, indexed cost. She purchased these shares in 2017 at rate of $1,20,000 for total. So take the land, 1/6 the distribution price, and the cash distribution price minus the indexed cost of acquisition. There will be a long-term capital gain or loss in the hands of Vasumathi. Now, Vasumathi transferred this land for, let us say, 20 lakhs, which is given in the problem. So what happened is that here there is a taxability in the hands of Vasumathi, because whatever she got, she sold. So 20 lakhs minus this value, which is nothing but the fair market value of this 1/6 land, will be taxable as short-term capital gain or loss. 3 points you have to write. Taxability discussion in the hands of the company, long-term capital gain or loss computation in the hands of Vasumathi for the 1/6 portion, and this land is subsequently being sold to a third party. There it will be a short-term capital gain or loss, because both are happening in 23-24 financial year. So this is a long-term here and there is a short term here, needs to compute both and then discuss the taxability. May 2008, this question has been asked a long time back. This has been asked, but quality problem which can be asked once again with the different data points. Practice this problem. Thank you.